Hello and welcome to this video. With our last video being about Bitcoin, it makes sense for our next video to concentrate on that other investment that's getting prevalent at the moment, which is stocks and shares. Now, just like Bitcoin, there's still going to be places in which we can help you make sure you're not paying unnecessary taxes, and also we can make sure that you understand exactly what happens and what the connection between Bitcoin and stocks are going to be, so again, you don't give yourself some unwanted taxes down the line. Stay tuned while we think about exactly what our options are, and at the very end we'll give you a little bit of a tip on how to make sure you don't have to pay any taxes whatsoever. Let's have a look. Hello, my name is Aaron Patrick. I'm a chartered accountant, certified UK trainer from QuickBooks, QuickBooks chap on the internet, and also head of accounts here at Boffix. Now, with being head of accounts at Boffix, we know exactly what it's like to have investments and wanting to make the most out of them. And at the moment, prevalence-wise, with things like Tesla doing so well, Apple always being there, and some really good ones by the looks of it in the terms of people like Coinbase and things like that, means that more and more of our clients are turning to stocks and shares. And that's great because that's an investment. That's going to be something that's going to help grow your finances and help you go forward. Now, obviously, we can't tell you which stocks and shares to go out and buy. That would be completely wrong of us. But what we can do is let you know about some of the tax implications. Because you must know that it's volatile to put your money into stocks and shares. It is risky, but there is some really good advantages of doing it. And as you can see with the success stories of things like Tesla and how that's performed over the last year or so, then you know that some massive gains can be made if you put the right investment in the right stocks and shares. A lot like Bitcoin, it's starting to get a lot more traction at the moment based on the fact that we've got all of these extra elements coming in. We've got the fact that we've got added people talking about it, we've got people on YouTube talking about it, we've got people giving advice and helping others be able to improve their wealth. But with all this extra wealth that's been accumulated also comes extra tax burdens as well. Now, there are ways to be able to trade within the stocks and shares without having to worry about taxes whatsoever, but just like Bitcoin, it's going to be more than just the one thing you're going to have to worry about. You're going to have to look at your collective share and Bitcoin and all your other portfolios when we look into the effect on what taxes can have when it comes from stocks and shares. Let's have a look at some worked examples and try and get our head exactly around what taxes we need to worry about. Let's have a look. Okay, so what we're going to look at now is just some worked example of how this can work. So the premise of stocks and shares is really straightforward. The idea is that you're going to buy into a company and you're going to buy their stocks. And for you to make profit on this, for you to benefit from this and increase your wealth, you're going to want to buy the stocks when they're low and then sell them when they're high. So as a work example, here's Apple. Here's Apple's share prices over the last 18 months. Now, when you buy those shares, you're then going to be looking to keep hold of them for as long as you possibly can. And the longer you keep hold of them, the more beneficial in this case it's going to be for you. But there's certain things to remember. Point number one, during the holding of the shares, you may be paid out what's called dividends. You see, dividends form part of your income. So when you're looking at your income in a particular year and you think about having to do a tax return, then it's quite straightforward to put in there things like your employed income, maybe your self-employed income. But another form of dividend that you can receive is dividends. And it doesn't matter if you receive a dividend from a stocks and shares you own from on the stock market, or if you receive dividends from your own particular company, they're dealt with in the same way. In fact, they're all pooled together and taxed at the same. The first thing to remember is that you get £2,000 each and every year, currently, of a dividend allowance. And think of a dividend allowance as the amount of dividends you can receive before you have to take account for any taxes. So if you're allowed £2,000 before you have to pay taxes, then you know that basically up to £2,000 you have no issue of taxes whatsoever. And then, depending on your personal circumstances, you may have some personal allowance left as well. Remember that £12,500 odd pound you get each year? Well, if you haven't used that on any of the other income streams that you've got, then that could still be utilised. But effectively, all dividends outside of that £2,000 and that £12,500, your personal allowance and your dividend allowance, are subject to taxes. And the amount of taxes you pay on them depends on what rate of tax or what band of tax you're in at that point in time. If you're in the basic band, then you only pay 7.5% on it. Once you go to the higher rate, it's 32.5%, and then the additional rate is 38.5%. So as you can see, it's significantly taxed more the higher you are in those tax bands. You jump from 7.5% to 32.5%. So dividends. Dividends can be paid to you without you even asking for them. So you need to account for that when it comes to tax planning. Your first $2,000 is completely tax-free, but if you already own, say, a limited company and you want to take money out of a limited company, then most of the tax efficient way is to utilise dividends there as well. So you may have already utilised your dividends. Also, when we say £2,000 of dividends, that's for every shareholding and every dividend you have in a particular tax year. So you could have multiple shareholdings with multiple companies, and if they pay you more than £2,000, then you have to worry about dividends afterwards. Think of dividends as almost interest. You being rewarded for holding on to those shares, helping that company invest in making the profits. But don't ignore the tax consequences that can come with them. From a tax planning point of view, ideally you want under that £2,000 limit, because as you'll see coming up next, you have a much bigger opportunity and a much bigger allowance when you start talking about capital gains. Okay, so back to our worked example. So looking at our worked example, we've held on to these shares and we've been paid out dividends maybe at certain points. And every time we're paid out a dividend, that goes on our next tax return. So when do we pay taxes on dividends? Well, it's always also remember to note that when you get paid a dividend, none of the taxes have been suffered at that point. You need to include that dividend on your next tax return and then pay the taxes due, if any, when you pay that year's tax return tax bill, normally the 31st of January. So, as an example, if today I held shares in a company that paid me dividends and the date was April 2021, first of all, I have to wait for the tax year to finish. I have to wait all the way to the 5th of April 2022. At that point, I then get invited to complete a tax return. Once I've completed that tax return, which is due the 31st of January 2023, and at that point, the 31st of January 2023, is when I'd have to pay any taxes that I would have had on those dividends. So remember, it could be a long time between when you receive that dividends to when you have to pay the taxes on it. So back to our worked example, we've talked about dividends. Let's talk about capital. So when you come to buy the shares, the only taxes you may have to worry about is possibility of stamp duty. So if you buy a UK company, there's potential for stamp duty to come into play. But whichever stock platform you're using, then you should be able to be told at that point if you're going to have stamp duty considerations. And it only applies for UK-based companies. But in my worked example, if I've bought in May 20 and I sell in November 20, then at May 20 I have no tax considerations to worry about other than possibly stamp duty. But it's when I sell the item that I've got to worry about tax. When I sell the stocks, at that point I'm going into capital gains tax again, just like we spoke about when we talked about Bitcoin. So let's recap what that capital gains element was. Well, effectively, if I buy something and then sell something that's relating to capital gain, then when I come to sell the item, I less what I paid for it originally, and that gives me my proceeds. My proceeds then are subject to capital gains taxes. Now, one of the good things is in the UK, as a UK taxpayer, we get £12,000 odd, depending on what tax year we're in, of capital gains allowance. And that's separate to all the other allowances we've talked about. So, in essence, we can make £12,000 of profits within a particular year before we need to worry about taxes on top. And when we do, they're at two different rates. They're either at 10% or 20%, depending if you're a basic rate or a higher rate taxpayer. So now we're back into capital gains tax like we were with Bitcoin. What do we need to worry about? Well, first of all, it's not just going to be stocks and shares and possibly Bitcoin that's going to trigger capital gains. If you sell a business, if you sell a property other than your own, these can also create proceeds and profits within your capital gains. So just having less than £12,000 of stocks being created or profits being created in a year doesn't necessarily mean you're going to avoid capital gains tax. Now, just like we talked about in the Bitcoin episode, you've got to be careful about the dates you use when it comes to selling shares. Because again, you're going to want to make the most of those allowances that you've got. So when you sell a share can be really, really important. If you've already utilised, for example, all of your capital gains allowance in this particular year, it may make sense to you to hold on to that share a little bit longer and try and sell it in the next available tax year. Tax planning like that can save you a lot of money when it comes down to capital gains taxes. And it could be the difference between your overall shareholdings making you a nice, tasty profit, or you're ending up having to pay additional taxes down the line. And just like we talked about the dividends, these capital gains aren't going to be taxed at source. So you're going to have to account for them on the next available tax return relating to the tax year you've just sold these shares, and they're going to be repayable on the 31st of January after the tax year that's finished when you've sold them. So you could have these shares being sold, you could generate this tax you need to pay, and you could completely forget about it and it could be paid at a later time, and that's when you could get yourself into trouble. So effective tax planning is essential. So let's recap what we've talked about. When you buy a share, potentially you could have stamp duty to worry about, but it shouldn't be that much of an issue. It's when you sell the share or shares that you're going to possibly generate yourself some extra taxes. During the life of holding the shares, you could be paid dividends, which means that you may have to worry about dividend taxes as well. So I said at the beginning of this, how can we avoid paying taxes on shares? Well, it's utilising those allowances. Making sure that if you sell your shares, maybe don't sell all of them off in one go, maybe spread them over multiple years so that you can take advantage of those allowances at each individual year. And the key to understanding all this is really adequate record keeping. Because again, I can't stress this enough, it's not just you interacting with your shares that are going to generate capital gains, but if you're also looking at the Bitcoin and you're also looking at buying and selling houses, then you could have yourself an absolute muddle if you're not careful. So again, let us know below in the comments. We are looking at using QuickBooks to be able to make it easier for people to be able to record their capital gains transactions. And if that's something that would be useful to you, let us know down below. Let us know in that comments box, and we can make sure that we can develop something together so that it's something that everyone can use and everyone can benefit from. Remember, here at Boffix, what we care about the most, we care about our clients making sure that they don't just survive but thrive. And when you think about it and you see some of the benefits and some of the big gains that have been made with stocks and Bitcoin and everything else lately, then that's definitely a way where clients can thrive and not just survive. Again, shares are very volatile, not quite as volatile as Bitcoin, but they are still very, very volatile. So it's still going to be risky for you. There's also the opportunity to use losses. There's also opportunity to use rollover relief. There's a load of different opportunities for you to make the most out of taxes. It doesn't just come down to buying and selling them and it stops there. So if you're looking for a specialist in this area, then look no further than Boffix. We would be more than happy to help you in your situation and help you get the most out of your share portfolio. If you found this video useful, don't forget to use the like, subscribe and everything else relating to YouTube. Comments and everything else just helps us grow this channel, get that algorithm working for us, meaning more people can get their eyes on this sort of content, meaning we'll help more people along the line. And that's what this is all about. My name's been Aaron Patrick. As always, it's been a pleasure to do this video for you. I'll see you in the next video. Bye for now.
I told him I can be a fighter if you want. I'll be there to catch you if you fall. I can make it brighter when it starts. I told him I would do it all for you, and I know you do it for me too. I can be a fighter if you want. Yeah, I can be a fighter. I can be a fighter if you want. I can be a fighter if you want. that it's real, cause I can get him out of my head. I don't care what we do, everything's feeling new. Even if we stay in bed, my heart is saying yeah, 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 yeah. You know I want him nah, 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 nah. My heart is saying yeah, 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 yeah.
Hello and thank you for watching that video. What you may not know is this channel that you've watched this video from is part of a wider group. That wider group is called Apple Core Production, and the 3 channels that we have involved are as follows: Aaron Patrick the QuickBooks Chat, Boffix Tax Tip. Finally, we have Apple Core Live and Geeky. All the links and everything are down below in the description, but it really means a lot to us if you can go and give a like to the other channels as well.